Today is April 6th, 2025, and I'm here to basically give you guys an update about what's going on in the market and what kind of risk we can see. My goal here from LG Capital Partners is trying to help you basically figure out how to allocate your money efficiently and how do we navigate through this turmoil that we have in the market. As you can probably be aware, in the past few days, stock market is at all-time low, and we've been having down dips every single day, basically because of the crazy tariff that we put in by Donald Trump, and that's really affecting the market. As you can see, this is really crazy. I mean, just previous day, pretty much every single market sectors in the S&P 500 has went down the toilet. Nothing has went up, almost. There's only a few outliers out there. That is Nike. Previously, Nike is making a lot of shoes from Vietnam. And basically, there was some news that Vietnamese government mentioned to the U.S. that they want to negotiate with the U.S. and accept the U.S. tariff. And that is a reason why there's actually a small update or rise in Nike by 3%. But as you can see, everywhere close, everywhere around the sectors, it's falling. And I want to basically update you guys on basically where we are in the economic cycle. So we understand what is the upside and the downside, because as investors, we want to understand the trade-off between the upside and downside. So let's go through it. Actually build an entire thing around the cycles. And if you can look at it closely, this is basically investment component share of GDP. And you can see that what I did is I plotted out the durables, so durables, residential, and equipment. Now, why would I want that? Very simple, because those are the cyclical side of the economy. And as you can see from this chart, really importantly, and this is updated daily, so I will give you guys an update if you guys need me to. Basically, whenever we have a upcycle, more investment, more durables, residential investment, and equipment companies would invest as well as consumers. That pushes up the market. As you can see, the stock market also rose at the same point as the investment on durables, residential, and equipment. However, when we have a downturn, that is when investment starts falling. So durables, people spend less money on durables, residential, and equipment, so people spend less, and therefore you have a downturn. So how you spot a downturn is when you can see that the cyclical side of the economy, durables, residential, and equipment, is on a downward cycle relative to the GDP. Because as you probably aware, like people have to eat food every single day, right? So that's not going to change. That has nothing to do with that will not have an impact on economic cycles. What is the economic cycle is relevant is when people don't invest or don't buy a home or don't invest in a dishwasher, or companies won't spend on equipment. That's really having a drag on the economy. So every single recession, we have pretty much the cyclical items falling down a cliff, and every single time. And now we're getting to a cycle now where investment is very weak. So durables, residential equipment is down relative to the GDP. And also you have the Fed lowering rates. Now, there's one thing I wanted you guys to know is that whenever you have the Fed lowering rate, you assume that is a great thing, but it's not exactly true, because whenever you have interest rate falling, right, that is exactly when the S&P falls at the same time. Now, you notice that this red line here is the Fed interest rate. So you can see the Fed lowering rates. Every time they lower interest rate, whenever it falls down to a low point and they stop lowering the rate, that is when you identify the bottom at the stock market. Every single recession, as the Fed lowers rate, you have the bottom as well. Every time. Every cycle is like this. It makes perfect sense, actually. So every time you have interest rate falling to a low level, that is when the stock has reached the bottom. And right now, we're at the beginning phase of the Fed lowering rates. And I can even tell you right now, based on the job report that we just had last week, it was actually a strong job market. So the Fed might pause a little bit, but we're still in this down rate cycle. I mean, eventually, yes, once the tariff effect hits, and we are not going to create jobs. I'm going to be frank with you. We're not going to create jobs. And the reason is because think of tariff, right? as a large sales tax on consumer goods. And so if the government decides to tax all of us, that means that whatever you would seem to have in your is you're definitely going to spend less money. And the U.S. is typically a consumer market. It's led by spending. It's basically, you can see the whole entire economy is based on service sector. And if people spend less money, there'll be less services incurred, and which means that company's profit will take a dump. And so from that perspective, it's not very wise to put tariff right now. And I can tell you through history that no country has succeeded so far by putting tariffs. I mean, if you look at China, when during the I think it was 1970s, China didn't basically invited the whole world to build factories in China. They didn't put tariff back then. They incentivized the companies to come back to come to China to build factories. Threat is not a good way to entice investment. And I think Trump's intention is very good. However, the approach is not very good. And I don't know who's advising him. But it's certainly not doing. And we can talk about this in our next video. But I can talk about a whole day over why this tariff thing is going to fall out. But if this thing doesn't change course, we're definitely going to have less consumer spending because everyone has to tighten their wallet. And it seems that the president is more interested in targeting trade deficit with other countries. Now we as a country actually spend more than what we save. Even our government spends more than what they collect. So by economic theory, like, and we can have a whole hour about this, like, next video explaining why the tariff is not going to work. So if you subscribe to my channel, I would definitely talk about that in the next video. But this tariff thing, like, we're not going to be able to lower the trade deficit because the individuals are saving less money, and also the government is spending more than what it collects. So we have a deficit. And because we have a deficit, we have to import more goods or services from other countries. And so obviously that creates a trade imbalance, right? And that's pretty much a U.S. structural issue. It is not caused by other countries stealing our jobs. Yeah, I mean, our jobs are getting replaced anyways by the robotic and AI. So it's not that, okay? We got to change. We really got to think. And that's why my next video is going to be completely about why the tariff is not going to work. But most importantly, the reason why I came out here to talk about this is because I really feel that I got to make sure that American investors are taken care of, that we need to know what's ahead of them. So as you can see here, again, the economic cycle downturn has just started because, yes, we'll take a pause in the interest rate per Fed because we had a strong job report, but you're going to find out that we are not exactly we're not going to have a very strong job market as soon as the customers start spending, and a lot of indicators are pointing weakness right now in the market. So we have a lot of downturns to go, and the stock would all obviously go down as well, and that is not. We're not even there yet, okay? We're not there yet. Now, if you look at the PMI, which is called the Purchasing Manager Index, you can see that things are also slowed down. So this is a survey on the manufacturers. The manufacturers purchase order or PMI, Purchasing Manager Index, which Purchasing Manager Index just means that asking the manufacturers, are you going to expand or are you contract? And unfortunately, based on the survey in March, it was a bad month. And so things has been going down and surveys are not good. And they're usually leading indicators. So not a good spot here. And as we'll see. Also, this is consumer sentiment. Consumer sentiment is terrible. This is terrible. And also and if you look at the consumer survey, they believe that inflation is going to skyrocket. So the Fed is not going to lower rate because the Fed believes that the inflation should be around 2%. We were very close or somewhat close, but then obviously because of tariff, we're back again. So no help from the Fed, because the only way that the Fed would ever lower rate is we would have a full massive unemployment layoff going on. And then, unfortunately, we are going to eventually get there, and I'll explain you why. Let's go down. Let's look at why the stock market has more rooms to fall. If you like Warren Buffett, this is the price to GDP over time. As you can see, we're at all-time high, And we pretty much need another even 30% or even more to go to historical norms. I mean, this is like a overpriced stock market, but if you stay with my channel, we'll go deep into what stocks we could invest to catch this downturn. I just hate to have people lose their shirt over in the 401ks, and this is the whole goal. I want to basically there's a lot of videos, unfortunately, in the YouTube that talks about the market, but I really want to join in on this and make sure that people listen to the facts and the data instead of just investing with their emotions. I mean, investment is not a good time to invest with your emotions because you get hurt. And I was one of them when I was in 2008, graduating as a financial analyst, but I just don't want you guys to make the same mistake that I did. Also, price over corporate profit. Yes, we're a norm, but if you can look, but our corporate profit is going to be taking a hit really badly. Tariff is going to hit our profit margins. So expect everything to go down further, as you can see from the cycles that I showed you before. Let's switch over to why the Fed is not going to lower rate. But first, what I would like to explain to you is that the Fed it's not only interest rate that the Fed is that you should be watching. It's also that the Federal Reserve also prints money during depressions or recessions, and they basically lower money supply or lower or draw liquidity out of the market and when they feel that there's too much inflation. But right now, as you see the dark black line, where the Fed is lowering liquidity every day, and they're reducing their investment on treasuries as well as mortgage-backed securities from the chart, as you can see here. So again, this is why we have this weakness is that when the Fed lowers liquidity, obviously that's a drag on the economy. And on top of that, you have the tariff, which is going to hit the corporate profit. So double whammy there, right? Also, let's see. Also, the 10-year minus the federal fund rate. So I know a lot of people talk about 10-year minus short-term treasury. Why is that important? Or why is the 10-year treasury rate minus federal fund rate very important? Is that this is an indicator on banks' profit, essentially. So as you can see, a bank, right, they take consumers' deposits and they basically lend it out for a longer term. Well, the 10-year term is more like, it's like a kind of an indicator that tells you how much you can make if you lend it if you lend a consumer or someone or borrower. The banks would lend you at a 10-year rate, but the banks have to pay people's the deposit rate at the federal fund rate or somewhere close to the short-term debt rates. And as you can see, that every time when you have a negative 10-year minus federal fund rate, we lead into a recession. So this is why the recession is coming. I mean, it's pretty much really obvious, and it's just market timing. So right now, I would say that you have to wait for the federal fund rate to keep lowering rates until they hit the bottom, and then you can pretty much buy the stocks right at this point. That is when I would be advising you. So please subscribe for my channel. Now, last thing I want to talk about is that last thing I want to mention about is let's see, let me keep going down. Okay, so this is the Taylor's rule. I actually modeled it, and you're comparing it to the federal fund rate, which is what the Fed and the lower rate. That's what they meant, federal fund rate. That there's very little chance that the Fed will be lowering rate. So again, no relief from the Fed because the red line is above the blue line, so not likely. So that's no relief from the Fed. Also, again, Fed has a dual mandate, and inflation is very high. They will try to raise the rate. They also have a mandate that if we have a huge unemployment, that is there to help us. However, as you can see from the recent weekly data, it's not going up. And I mean, they just released it in March of 23, and as you can see here, actually, I take that back, March 30th. As you can see here, the initial claim is 219, so it's actually lower than the previous month or the previous week, and the continued claim is about the same. So we actually had a pretty strong job market, and so no spike whatsoever. However, there is definitely weakness in the weekly initial claims, and the job data is actually a lagging indicator. As you can see here, when you lay off people, first have to get rid of job openings, right? So if you have a lower amount of job openings, and you first have to eliminate them first. Okay. And then you can think about, okay, let's lay off the people. So you have to lower the job openings on the, I don't know what employers use these days for post job openings, but opening is that it's pretty low, and it's still pretty good, but expect this to fall down even further. And also the durable goods is somewhat strong, but still going down. I mean, right now we have a lot of job opening level to go through, so that's why you have a strong job market. But that's not helping us because the job opening is trending downward. And again, we're just at the beginning of the recession. I mean, even if Trump calls off the tariff, I think the trend is still against us because the Fed is not lowering rate anytime soon. And we already have weaknesses, and this tariff thing is just going to throw us into a bigger, a wrench because if you think about it, our investment is what durables was already down, and that was already part of the cyclical pre-tariff. So now with the tariff, it's going to be even worse because we have less. We're all going to have to tighten our belt, and that just means less spending, which means less jobs. It's just not a good sign. I will be talking about what we should be investing right now. I would say is stay out of stocks, minimize your stock exposure, and definitely invest more in the TIPS, Treasury Inflated Bond. And I'll explain why in our next future videos, why you want to invest in TIPS. You may want to also invest in alternative assets like real estate, other things can hedge your bet. Most importantly, we have a long way to go, and it's very important to invest in more recession-proof stocks. So we will talk about that in our next video.